Hello there. Welcome to grade 11 accounting. Today we want to look at a question from the past exam paper. This is June 2023. The question is on accounting equation. First question, that is question 1. On that question paper, this question is got 15 marks and it requires you to spend about 10 minutes on that question. Let's take note of the time required there. This question reads, analyze the following transactions and show the effect on the accounting equation. Then take note that the bank balance remains favorable at all times. Very important. Then we've got transactions that were given there, and obviously we also have on the answer section, the answer book, what we are given, where we are going to put our responses. We go there. That's where we have there. So we have got 1.1 up to 1.5 there. That where we are going to put the account debited, and then we've got also the column for account credited. And then we are supposed to go on and show the effect on the accounting equation, having those 3 elements, that is assets, owners, equity, and liabilities. So what is important there is to first of all put down the 2 accounts that are being affected by every transaction. Remember, every transaction has got a double effect. That is 2 accounts are going to be affected. So we have to put down the 2 accounts that are going to be affected. Then I will see if there is an increase or a decrease in each and every component of that account equation. And then we show the effects on the second part, right? The accounting equation basically, accounting equation on its own basically explains it being the foundation of double entry. So basically what we are saying is double entry is formulated from the accounting equation. And we'll see that whenever we have got double entry, the effect of the double entry on the accounting equation should not affect the 2 sides of the accounting equation. Remember, the accounting equation is assets is equals to owners equity. Then we add liabilities. These are 3 elements that we have on the accounting equation. So you have to take note that when we have a transaction, it should not affect the totals of 2 sides. As in the side of the this side, we have got 2 sides that are there, this side and this side. You'd see that this left-hand side, the total should be equal to the total of the right-hand side. So whenever you have a transaction, the effect that transaction is going to have on the 3 elements, it should not affect the totals in terms of the quality of the 2 totals of the left-hand side and the right-hand side. So we are going to see that when a transaction increases assets in such a way that the 2 balances should be the same, that is the left-hand side and the right-hand side. When it increases assets of this side, if it's affecting the other side, either on owners equity or liabilities, we are also going to have an increase on liabilities. But if it's affecting liabilities, if it's affecting owners equity and the assets, it's an increase and an increase. That's what we are going to see. So but if we are going to see a transaction, maybe in the case that that transaction is only affecting one side, that is, it's affecting one of the accounts is on owners equity and one of the accounts is on liabilities, we are going to see an increase and decrease. So if it's owners equity and liabilities, you will see that if we have an increase in owners equity, we have a decrease in liabilities, in such a way that the total does not change. In such a way that if we have got a plus 20 here, we should also see a minus paid on liabilities, and the total will just remain the same. In other words, here we are saying 20 minus 20 is 0, so no effect on the balance. That's what we are going to have. But if the transaction is affecting 2 sides, that is the left-hand side and the right-hand side, it's a movement in the same direction, or we are going to see a positive relationship whereby we have got an increase on assets and an increase on either owners equity and on liabilities. So that's what we have. So what we are going to do on our questions that we have, we are going to put the 2 accounts that are being affected by each and every transaction. Then when we have 2 accounts, we indicate which one is going to be debited, which one is going to be credited. Then we see now each of the accounts, how is this it's going to affect one of these three elements, that is assets, owners, equity, and liabilities. So let's move on to the first part, which is saying a partner, A. Matome, increased his capital contribution from 966,000 to 1,222,000. So basically, we are having an increase in the capital contribution. In other words, the capital has increased. So let's first see it is increased with how much. We now say 1,222,000. We subtract 966,000. So you see that if you do this, the amount that you are going to get there, the difference becomes 256,000. So that's what we have there. So in that case, this is the amount that we are going to debit and credit. So the two accounts that are there, remember there's capital contribution, so we have got capital account that is there. And this capital account is obviously, it's coming in the form of money, so we can just assume it's bank. So the two accounts that we have there is bank and capital. And this capital contribution is for A. Matome, so we can just say Matome here, capital for Matome. So what we have there, we have bank and capital, which is Matome. So what we are going to do there is, let's see here on bank, we are receiving money. This capital contribution is coming in the form of money, so the business is receiving money. So bank is the one which is receiving, and remember, bank is an asset. So whenever we debit an asset, it's a plus. So on assets, whenever we debit them, so let's say we debit them, we should show it by a positive sign. But when we credit an asset, you should show it by a negative sign. So the opposite is true for liabilities again. When liabilities, now we are saying on liabilities, we are saying if you debit, it becomes a negative. Now it's opposite now. When you credit, it becomes a positive. So that's what we have. So here we are debiting because we are receiving money, and when we are receiving money, we should show it on the debit side. We debit, and then obviously capital. Now when the capital is being introduced, the capital account is always credited. So we credit here. So you see that when capital is credited again, it's a positive. It's a positive. So there now we are going to see that on the bank, since we are debiting, and say we are saying when you debit an asset, it's a plus. Here we are saying plus this one, which is the difference, 256,000. And here now it also becomes a plus, which is 256,000. So we are seeing that effect that this bank is an asset. So it's here, it's a plus on the asset side. Then capital is on the other side, which is owner's equity. We are also seeing a plus. So when the transaction is affecting both sides, the right hand side and the left hand side, we are going to see a plus and a plus. But if it's affecting one side, like maybe it's affecting owner's equity and liabilities, we're going to see an increase and a decrease. So that's what we have there. So we can go there and summarize on the other section, that double entry that we have there. So you're going to see that the account that we debited there was bank. So we're going to say bank. And the account that we created, capital. Capital, and remember, this is Matome. And then this one we said it's a plus on the asset side, 256,000. And then owner's equity also is a plus, which is 256,000. Right. Then we go to the next one, which is 1.2. 1.2. On 1.2, it's saying the business purchased. Let's see there. Right. On 1.2, it reads the business purchased merchandise from Komodo traders worth 250,000 rands using EFT. So there we have got EFT. So it means this is through bank. And we have got a purchase that has taken place there of merchandise. So this is a trading stock that has been purchased there. So basically, the two accounts that we have there, we have the trading stock account, and also we have got the bank account being affected there. So let's save the two accounts, which is trading stock, and also we have bank. So you see that here money is going out of the business. So based on the principle that we debit the receiver, credit the giver. you see that money is going out, so bank is being the giver there. So we credit bank, and then the trading stock is the one that is coming into the business, so it's receiving, so we debit there. So the amount that we have is 250,000. Then we see which these two accounts are on the accounting equation, all the three elements are there, which one is being affected. So if you first look at trading stock, you see that trading stock is an asset there, so it's going to be on this part, and you are debiting it. So whenever you debit an asset, it's a plus. Whenever you debit an asset, it's a plus. Remember here, so we are debiting here, so it's a plus here on the trading stock part. Then credit bank is also an asset, but you are crediting, when you credit an asset, again it's a minus. So you are going to have a plus and minus on the asset side there. So that's what we are going to see there. So we just go and summarize that one. So that the one that is being debited is trading stock. Trading stock there. And the one that is being credited is bank. So yes, we are going to see a double effect there on assets, whereby we got a plus 250. And also we have a minus 250. So that's what we have there. Then we go to 1.3. On 1.3, saying the business received an invoice from Nadella Stores. Look here, the business received an invoice from Nadella Stores for stationery bought on credit 6,700. So whenever we buy stationery, it's an expense. But when stationery is left at the end of the period, it becomes a trading stock. So we regard it as an asset now. When we've got stock that is not used during the period, it becomes an asset. But when we buy it, we regard it as an expense there. That's why in the income statement, when we are now calculating the expense part of the stationery, we now say stationery that has been bought minus stationery at the end to get the one that was spent. So in this sense, we are just told that we bought stationery there. So it becomes an expense. So it means we've got stationery account there. And also it's on credit, very important. So when it's on credit, it means we are going to open the name of the person or business that we bought from on credit, that is Nadella Stores. And Nadella Stores becomes a creditor. So the two accounts that we have there, we have stationery as an expense. Stationery as an expense, and we've got also the creditors control. Remember, the Nadella is a creditor. Creditors control, and obviously this is Nadella. So here we are buying. This is stationery, and it's a expense, and all expenses are debited, and we know that all expenses are debited and income is credited. So here we debit, and it's a DR, which is debit, and then with creditors, obviously when we pay on credit, we are supposed to credit the name of business. Here we credit. So on the effect now on our accounting equation, you are going to see that stationery as an expense here is going to be charged in the income statement under operating expenses as an expense, and it's going to reduce the figure for net profit. And we know that net profit, we then carry it to the statement of financial position or balance sheet, and it's going to increase. If it's a net profit, it increases the owner's equity balance or the capital balance. But if it's a loss, it's going to reduce the owner's equity balance. So in this case, if it's a profit, we are saying it's reducing. So you see that when it comes now as an expense, it's a minus on the owner's equity. It's going to reduce the net profits, thereby also reducing the owner's equity. So it's a minus on this part as an expense stationery. Then you've got creditors control. We are increasing creditors, so here comes a plus. So you see that this effect is on owner's equity and liabilities on one side. So you put an increase and a decrease. So we go there and summarize that one again on the answer book. If you come here on the debit side, we have got stationery on the debit stationery. And on the credit, we have got creditors control. creditors control. And this one, we are saying it's a minus on the owner's equity part. So we've got a minus 6,700 and also a plus there on liabilities 6,700. Right. Then we go to the next one, which is 1.4. So on 1.4, it's saying sold goods 1.4. 1.4 is saying sold goods on credit for 300,000. The business uses a profit markup of 50%. There now, let's see how we can calculate that one. So when these goods were sold, were sold, you're going to see that we are going to have two double entries there on this part 1.4. Because when these goods were sold, we are going to credit sales account, and they were sold on credit. So what it means when they are sold on credit, we instead of debiting bank or cash, because when you sell, we are receiving, we are supposed to debit the bank and cash if it's on cash basis or check. But the year it's on credit, so you're going to debit the debtors control, the name of the personal business that we've sold goods to on credit. So we debit the debtors control and credit sales. But also we have the issue of cost of sales here. An issue of cost of sales. Remember, when we are selling on cost price. Remember, selling price is equals to cost price plus markup. So plus markup. That's what we have when selling price, final selling price, cost price plus markup. So here, cost price is always 100%. Cost price is always 100%. Then the markup depends on the rate that you are given. Each person you are given 50%, so it becomes 50%. So our selling price means it's 150%. So that's what we have there. So we are also going to the other two accounts that are there. We have got cost of sales. We are going to debit cost of sales. And then we are also going to credit the trading stock account with the cost price of the goods that has been sold. With the cost price. So to find the cost price now, we are not just using proportion that this figure that we are given 300,000 is the selling price, which is 150%. And the figure that we are looking for is the 100% that we want to debit cost of sales and credit trading stock. So we just use a proportion there. We just use a proportion there whereby we say 150% is equal to 300,000. So the figure that we are looking for is 100%, which is obviously going to be a lesser figure. So I will just make a proportion this side, side that we put both figures. So we say what we don't have is 100, we put it as a numerator, and what we have is 150, put it as a denominator. Then you multiply by the given amount, which is 300,000 over 1. So if you multiply that one, let's try to multiply that one. Obviously, we are going to get 200,000. So that becomes the cost price, 200,000. Yeah. So this is the one that is going to be debited here. Cost of sales, we are saying we are debiting. And then we are crediting the trading stock, the cost price, which is 200,000. Then the other double entry that we have there is sales. We have sales and the debtors control. Sales and debtors control. And sales, obviously, we know that we credit sales. Sales is always credited, and then we debit the debtors control. And the amount that we are going to use there is 300,000. Its selling price is 300,000. So these are the two double entries that we are going to summarize there. So if you come here, now we are saying we've got two sections that we are given. So on the first, we are going to put the first one, which is we are debiting debtors control. This is debtors control. And then we are crediting sales. And remember, the effect now on the accounting equation, this is debtors control. This is an asset. When we debit an asset, we increase. So we are going to see a plus here, 300,000. It's selling price. And also, when you're crediting sales, remember sales is adjusted in the income statement there, and it increases the figure for net profit as revenue. So when it increases net profit, it's also going to increase the owner's equity. So here we also have a plus 300,000. And then the other second double entry that we have got cost of sales that we are debiting. And then we credit trading stock. Credit trading stock. So this is now at cost price whereby we say we calculated it and it was 200,000. It was 200,000. 200,000. Remember, trading stock, we are crediting. Trading stock is an asset, and when you credit an asset, it's a minus negative subtract. Then cost of sales is adjusted in the income statement in the trading account there. It reduces the figure for owners equity. In other words, it reduces profit, net profit figure, and then also the same having the same effect on owners equity, negative again, 200,000. So that's what we have there on 1.4. Then we try to see what we have on 1.5. So on 1.5, let's try to see there. Right, on 1.5 is saying paid 89,000 rands to Tami Bank for the payment of loan. Paid 89,000 rands to Tami Bank for the payment of loan. So this repayment of loan, and obviously we have bank there. We have bank that is there. Bank is one of the accounts. Let's say bank. And obviously what is being paid is loan here to Tami Bank. So we have got loan also. In this Tami Bank. Right, so that's what we have. And then we are paying. So we are money is going out of the business. So bank is the giver there. So we credit bank, and we are repaying loan. Remember, at first on the loan account, when we take a loan, we credit, show that it's a liability. Liabilities are credited. But when that loan is being repaid, we go to the opposite side and debit to reduce the amount of loan that has been paid. So that's what we are going to do there. We are going to debit our loan. And obviously the figure that we have there is 89,000. Then we'd see that this is a credit on bank. We are crediting an asset. It's a reduction minus. And also we are debiting a liability. A loan is a long-term liability, non-current liability. We are debiting it. So we are also reducing, because when we credit liabilities, that's when we increase. But when we debit them, we are reducing. So we come here and summarize that one. So what we are saying here, we are saying what your debit is loan. And remember, this is Tami Bank. And then we are crediting the bank. And the effect is on assets, which is a negative on this part. Crediting bank, negative 89,000. Then also a negative on liabilities, which is negative 89,000. Right, so that's what we have, guys, in terms of the accounting equation. Stay tuned for more videos to come as we prepare for exams. Stay tuned, and those who haven't subscribed, please subscribe for more videos, get notifications. With that, we'll meet again in the next video, and I'm signing out.